Good day, my name is Callistus Mahindi. In this video, we continue our exploration of income taxes in accordance with IAS 12 income taxes. Today's focus is on the calculation of the current tax expense, particularly in scenarios involving temporary differences. By the end of this unit, you should be able to explain how temporary differences occur. Discuss the reasons for temporary differences. Account for temporary differences caused by the accrual system, depreciable assets, and assessed losses. Let's begin by defining temporary differences. Temporary differences are also known as timing differences. They arise due to discrepancies in the timing of recognition of certain items in accounting profit versus taxable profit. These items are recognized in both accounting and taxable profit, but in different periods. These differences will reverse over the long term, therefore aligning accounting profit to taxable profit. Reasons for temporary differences. 1. Different systems. The accounting system uses the accrual system, while tax authorities apply a hybrid of the accrual system and the cash basis. Another reason for temporary differences is due to differences in depreciation. The accountant uses estimated useful life and methods to calculate depreciation, while the tax authorities prescribe specific wear and tear allowances. Tax losses. Carried forward tax losses reduce taxable income in future years. This creates deductible temporary differences. Note: temporary differences may lead to the recognition of deferred tax assets or liabilities. We will learn more about deferred tax assets and liabilities in the future. Let us look at the temporary differences that are caused by the accrual system. The accrual system, which is the accounting system, recognizes the effects of transactions when they occur rather than when cash is received or paid. The hybrid system, which is used by the tax authority, taxes income on the earlier of cash receipt or when it is actually earned. Let us focus on temporary differences caused by the accrual system. We will look in particular at temporary differences that result as a result of income received in advance, provisions, and prepaid expenses. Temporary differences caused by the accrual system. In this slide, we'll be looking at income received in advance. Income received in advance from a receivable. The tax authorities will tax the receipt in year one. That is when it is included in taxable income. However, the accountant will include the income in accounting profit in year two. So how will the accountant provide the journal entries in year one and year two? Let us look at this. What journal entries would the accountant pass in year 1 and year 2 per the International Financial Reporting Standards? You can pause the video here and record the journal entries before moving on to the next slide. Receipt of the income. The accountant will debit bank and credit income received in advance. That is to recognize the income received in advance in year 1. You will see that the bank is an asset, while income received in advance is a liability. So in this instance, the profit was not affected by the income received in advance. In year 2, the accountant recognizes the income by crediting sales or services rendered and then debiting income received in advance. The income received in advance is a liability, while the sales or services rendered is an income. And in this year, this is when the income hits our statement of profit or loss, and thus it affects our profit. Next type of temporary difference is a temporary difference that is caused by provisions. Provisions are dealt with in IAS 37. So what is a provision? A provision is a liability of an uncertain timing or amount. It is uncertain as to when you're going to pay it and also the amount of which you are going to pay. The accountant recognizes a provision when it is incurred. Thus, it reduces accounting profit in the year that it is incurred, for instance, year 1. While the tax authority will only allow a deduction of the provision when it is actually paid. For instance, the provision may be paid in year 2. We can think about a provision for warranty costs. What journal entries would the accountant pass in year 1 and year 2 to account for a provision for warranty costs, assuming the provision is paid in year 2? Year 1, the accountant would debit the warranty cost expense, which would affect our statement of profit or loss, thereby reducing the profit for the year in year 1. And then they would credit the provision for warranty costs, which is a liability which affects our statement of financial position. In year 2, the accountant will debit the provision for warranty costs and credit the bank account on settlement. Therefore, in year 2, our statement of profit or loss is not affected. Temporary differences caused by prepaid expense. So what is a prepaid expense? It's a payment for an expense before it has actually been incurred. You might think of a rent expense for the business. For example, a business might prepay rent months in advance or even a year in advance. So the accountant will recognize the expense in accounting profit in year 2, while the tax authority may allow a deduction of that expense in year 1 when it is actually paid. Journal entry would the accountant pass in year 1 and year 2 to account for prepaid expenses? Assume the prepaid expense is prepaid rent. The accountant would debit prepaid expenses and credit the bank to recognize the prepaid expense. In this year, no item hits our statement of profit or loss, and that's why the profit is not affected in year 1. In year 2, the accountant will debit the rent expense and credit the prepaid expense to derecognize the prepaid expense. In this year, our statement of profit or loss is affected by the debit entry that was passed when debiting the rent expense. Temporary differences caused by depreciable assets. Accounting depreciation or amortization is based on the useful life, residual value, and depreciation method. However, tax depreciation, also known as wear and tear or capital allowances, are based on fixed rates set by legislation, independent of accounting estimates. Accounting depreciation and wear and tear may differ annually, but will equalize over the asset's life. Therefore, when you're reconciling accounting profit to taxable profit, you will add back accounting depreciation and deduct the wear and tear allowance. Before moving on, let us learn about terms used by the accountant versus those used by the tax authorities. The accountant will use the term depreciation, while the tax authority would use the term tax deduction or capital allowance or wear and tear allowance. The accountant uses the term carrying amount, while the tax authority uses the term tax base. The accountant might say profit on the sale of an asset, while the tax authority will use the term recoupment on the sale of an asset. The accountant will say loss on the sale of an asset, while the tax authority will use the term the scrapping allowance on the sale of an asset. Amount versus the tax base. The carrying amount for the accountant would be the original cost less accumulated depreciation. This would give you the carrying amount. While for the tax authority, the original cost less the accumulated deductions or accumulated wear and tear would give you the tax base. Disposal of assets. Profit or loss on disposal. For the accountant, the proceeds less the carrying amount would give a profit or a loss on the sale of an asset. However, for the tax authority, the proceeds on the sale of the asset less the tax base will give a recoupment where there is a profit and a scrapping allowance where there is a loss. Let us deal with this activity whereby we look at the profit or loss of the disposal of non-current assets. The scenario reads as follows. ABC Limited acquired a machine on 1 January 2018 at a cost of 300,000. Depreciation is provided for over a useful life of 4 years using the straight line method, and there's a nil residual value. The tax authorities allow a wear and tear allowance over 3 years. Assume a tax rate of 30% and a company year end is December. The profit before tax is 100,000 Namibian dollars per annum. You are required to calculate the current tax for the years 2018 to 2021 and provide the general journal entries to account for the current tax payable. The suggested solution is as follows. The first step in determining the taxable income is to calculate our depreciation and wear and tear. Depreciation is determined by taking the cost price of 300,000 and dividing it by 4 years. Thus, the depreciation per annum over 4 years is 75,000. To calculate the wear and tear, we take the cost price and divide it over 3 years. That is allowed as a deduction by the tax authorities. Therefore, 300,000 divided by 3 is equal to 100,000 over the 3-year term. The next step is to determine the taxable income. Taxable income is determined by converting accounting profit to taxable profit. To do this, we adjust the accounting profit before tax with items that the tax authorities do not allow. In this instance, depreciation is not allowed as a deduction in determining the taxable profit. Therefore, we add back the depreciation to the profit before tax. However, the tax authorities allow wear and tear as a deduction. We therefore deduct this profit from this wear and tear from profit before tax. For the years 2018 to 2020, the taxable income is calculated as 75,000. This is done by adding back the depreciation of 75,000 to the accounting profit before tax and deducting the wear and tear allowances that are allowed by the tax authorities. The tax expense for the 3 years 2018 to 2021 amounts to 22,500. That is 75,000 times 30%. In 2021, the wear and tear allowance has been fully utilized. Thus, there is no deduction. However, we still have 1 year of depreciation amounting to 75,000. We add this to the profit before tax and determine a taxable income of 175,000. The income tax expense is 30% of the 175,000, which amounts to 52,500. So let us now look at the journal entries that would be provided to account for the income tax expense. So to account for the income tax expense for the years 2018 to 2020, we would debit our income tax expense with 22,500 and we would credit the current tax payable with 22,500. In 2021, the tax expense was higher. We therefore debit the income tax expense with 52,500 and we credit the current tax payable with 52,500. What is the total tax for the 4 years based on accounting profit versus the tax based on taxable profit? The total tax based on accounting profit versus the total tax based on taxable profit. The tax on accounting profit will equal to 30,000 per annum. That is 100,000 profit times the tax rate of 30%, which gives an amount of 30,000 per annum. Over 4 years, the total tax expense will be 120,000. That is 30,000 times 4 years. We have already calculated the tax based on taxable profit. That was for 2018, we had an amount of 22,500. The same was for 2019 and 2020. While the tax expense for 2021 was 52,500. That gives us a total tax expense at the end of year 4 of 120,000 over the 4 years. Therefore, you can see how the tax based on accounting profit and the tax based on taxable profit will over time equalize because of the timing differences of depreciation versus wear and tear. Let us go on with another activity, but in this instance, we assume that ABC Limited decides to sell the machine on 31 December 2019 for an amount of, in the first instance, it's 170,000, and in the second instance, it's 120,000. So the required is to calculate the current tax payable for the year ended 31 December 2019. To determine the profit or loss on disposal, the accountant will take the proceeds less the carrying amount, and that will give a profit or loss on the sale of the asset. However, the tax authority will take the profit less the tax base, and that will give a recoupment or a scrapping allowance if it is a loss. For the accountant, the first step is to determine the carrying amount. The carrying amount is your cost minus accumulated depreciation. The cost price of the asset was 300,000 and it was depreciated on a straight line basis over 4 years. Therefore, the depreciation per annum was 75,000. However, we have now depreciated this asset over 2 years. So 75,000 times 2 gives us an accumulated depreciation of 150,000. We then take the cost that we started with of 300,000 minus the accumulated depreciation of 150,000. That will then give us a carrying amount of 150,000. If we take the proceeds of 170,000 minus the carrying amount of 150,000, the profit on the sale of the asset will be 20,000. To determine the tax base of the asset, we take the cost price of 300,000 and subtract accumulated wear and tear. The wear and tear is calculated as 100,000 per annum. That was 300,000 divided by 3, which equals the 100,000 per annum. Over 2 years, the accumulated wear and tear is 200,000. That is accumulated at the end of 2019. Therefore, the cost price of 300,000 less the accumulated wear and tear of 200,000 gives us a tax base of 100,000. Taking the proceeds of 170,000 less the tax base of 100,000, we get a recoupment on the sale of the asset of 70,000. For scenario B, to determine whether we have a profit or loss on the sale of asset, we were given that the proceeds were 120,000. We've already calculated the carrying amount to be 150,000. Therefore, we make a loss on the sale of asset as 30,000. While in the authority's case, you start with the proceeds of 120,000, subtract your tax base, which we calculated at 100,000, and still the entity would have made a recoupment of sale. In this instance, it is 20,000. We continue, and the next step is now to determine the taxable income as well as the tax expense. So in scenario A, where we made a recoupment on the sale of asset, we will have a tax expense of 37,500. And the same goes for scenario B, where the tax expense is still 37,500, and that is because the taxable income was calculated in both instances to be 125,000. So let us start. We started with our accounting profit before tax, and we had to add back our depreciation less our wear and tear expense. Then we deduct for scenario 1, where we made a profit on disposal, we deduct that 20,000, but then we add back our recoupment on the sale of the asset. This gives us a taxable income of 125,000. In scenario 2 or B, we do the exact same steps. We had an accounting profit before tax of 100,000, add back our depreciation of 75,000, less the wear and tear allowance of 100,000, add back now our loss on disposal of 30,000 and add our recoupment of 20,000. This gives us a taxable income of 125,000. So looking at this scenario, we can clearly see that temporary differences arising from depreciable assets are resolved over time, even in cases where the asset is disposed of, such as in this scenario. The final reason for temporary differences that we are going to look at is temporary differences that are caused by tax losses, also known as assessed losses. A tax loss occurs where taxable income is negative. No tax is payable in the year of the loss. An assessed loss can be carried forward to offset future taxable profits. This creates a deductible temporary difference. If a tax loss cannot be carried forward, it is a permanent difference. In other words, it is a non-deductible difference. Let us look at activity 3, which illustrates how assessed losses can be used as a future deduction for tax purposes. The scenario reads as follows. Calculate the current tax for each year if the following applies. The cost of the vehicle is 150,000. We have depreciation over 2 years, while the tax authorities grant wear and tear allowances over 3 years. The profit before tax after deducting depreciation for the 3 years is as follows. In year 1, there's a loss of 80,000. In year 2, there's a profit of 25,000. In year 3, there's a profit of 70,000. The applicable tax rate is 30%, and you are required to calculate the taxable income as well as the tax expense over 3 years, assuming that the tax losses can be used as a tax deduction in future years. Before we can calculate our taxable income or a tax loss and the tax expense, we first have to start with calculating our depreciation and wear and tear. Depreciation was provided over a 2-year period. Therefore, we take the cost price of 150,000 divided by 2, and that gives us depreciation of 75,000 per annum. To determine the wear and tear, we take 150,000 divided by the 3 years that the wear and tear allowance is provided on, and we get an amount of 50,000. To calculate our taxable income, we have to adjust the accounting profit or loss to the taxable profit or loss. Thus, in year 1, we start with our accounting loss before tax, which was 80,000. And then we add back depreciation of 75,000 and deduct the wear and tear allowance of 50,000. This gives us a tax loss of 55,000. We do not account for tax on losses. This loss can be moved forward to future years as stated in this scenario. Thus, we will move it forward to year 2. In year 2, we start with our accounting profit before tax of 25,000. And then we add back our depreciation of 75,000 and subtract our wear and tear allowance of 50,000. We also subtract our assessed loss that was brought forward of 55,000. This gives us a loss of 5,000, which we can move forward to year 3. To calculate taxable income in year 3, we start with our accounting profit before tax of 70,000. Our vehicle is fully depreciated, so there is no depreciation. However, we deduct the the wear and tear allowance of 50,000. And we also deduct the assessed loss that is brought forward of 5,000. This gives us a taxable profit or taxable income of 15,000. The tax expense is 30% of the taxable income, and this amounts to 4,500. Use the same example as activity 3, but assume that assessed losses may not be carried forward to subsequent years. Pause the video here before looking at the suggested solution and attempt the question on your own. In year 1, we start with our accounting loss of 80,000. We add back our depreciation of 70,000 or 75,000 rather, and subtract our wear and tear allowance of 50,000. This gives us a taxable loss of 55,000. This cannot be carried forward to year 2. In year 2, we start with our accounting profit before tax of 25,000, add back our depreciation of 75,000, less our wear and tear allowance of 50,000, then we achieve a taxable income of 55,000. The tax expense is 30% of that, so 50,000 times 30%, we get an amount of 15,000. In year 3, we start with our accounting profit before tax of 70,000. Our vehicle has been fully depreciated, so there's no depreciation to add back. We subtract our wear and tear allowance of 50,000, and then we have a taxable income of 20,000. The tax expense will be 30% of that, and that amounts to 6,000. Looking at this scenario, we can clearly see that where assessed losses are not allowed to be carried forward, our tax liability will be more than when the assessed losses are allowed as a deduction against future profits. In conclusion, we have learned how temporary differences occur and how to account for temporary differences arising from the accrual system, depreciable assets, and assessed losses. In future lessons, we will learn about deferred tax.